Hello and welcome to the Astranti Pre-seen Analysis for the November 2016 Strategic Case Study exam on Dairy Farming Company ADF. So before we begin, I'm just going to start by telling you a little bit about myself and a bit about how we are going to approach the pre-seen and the things we're going to be looking for. So my name is Peter Steffer. I am the Director of CIMA here at Astranti. I've been with the company since 2013, and during that time I've written and marked many of the mock exams that we provide, and I've also written mocks for other tuition providers. I've also written many of the study texts that you may have used. And if you see in the bottom left hand corner there, my Facebook page, on the run up to the exam I'll be posting all kinds of hints and tips. So now let's take a look at the video series themselves. So for starters, I'm going to go through the pre-seen section by section, picking up on all the key points, the things that you should be looking for, the things you should be pulling out of the text and analysing. I'll then be applying them to the case itself, what they mean for the company and what it means for the industry that it operates in. Applying certain business models to it, ones that you may have learnt in your objective test studies, and the likely exam issues. So looking at it and thinking, based on this information, a likely question is X. And also other just hints and tips, general things that will help you gain extra marks in the exam. I'll then go on to my strategic analysis video, which will be taking the pre-seen as a whole and summarising it and applying it into lots of different key business models and key business theories before rounding up with my top 10 issues. So these are the most likely things I think are going to come up in the actual exam. So how's it going to work? As I said, I'm going to go through it section by section. I'm going to assume that you haven't read the pre-seen. I'm going to assume that this is all new to you and we are going through it together for the first time. And what I'm going to do is I'm going to ask you to make notes yourself. So I'll stop the videos at the start of each one and ask you to make notes on a certain number of pages, and then we'll go back and review it together. And as I've said, at the end we'll go through a full strategic analysis and top 10 issues. So first of all, some key things that you should be aware of. Now, the pre-seen is the context of the exam. It's the context of the company that is being examined. The background information, as it were. So once you've read the pre-seen, this should all be forming a foundation in your mind. And when you go into the actual exam, all the unseen questions that come up in the actual exam, you should be answering them based on this base context from the pre-seen. But it's worth noting that you shouldn't write anything based on the pre-seen. And that's because you're not necessarily going to be tested on something that's in the pre-seen. You'll be tested on the unseen material that you are given in the exam. If that unseen material is nothing to do with the material in the pre-seen, then you shouldn't be using the pre-seen material to answer the question. You must always use the unseen material. Having said that, you should always be thinking about the pre-seen material. Now, you're given this in advance for a reason. You're supposed to learn it and you're supposed to gain as much understanding as you can about the company so that you can use this information in the actual exam. So let's take a look at the case now. Now, the first thing many students will do when they get the case study is they'll skip ahead to the Swot analysis, they'll skip ahead to the risk register, the financial statements, and they'll ignore all the introductory material because they think that it's not as tangible as the financial statements, as the risk register, for example. But actually, just as the pre-seen is the context of the unseen, the context of the exam, the introductory page is in turn the context of the pre-seen. So there's actually a lot of useful information here. Now, the first thing you'll see is a section here about our role, your role in the exam. So we are a senior manager at the Anderson Dairy Farming Company, reporting directly to the board and advising on special project and strategic matters. So That should give you an idea of the kind of things that you'll be expected to talk about in the exam. You're talking directly to the board. You're giving them advice that is going to directly affect their actions taken on strategic developments for the business. So this is not day-to-day operations. This is long-term strategic developments of the business. So you must always factor the long term into your responses, into your answers in the exam. You shouldn't just be answering the question for the here and now. You should be considering the sustainability of this plan for the future, whether the external environment is going to change in the future, and thus this plan that you're suggesting will not be applicable and useful in the future, and therefore you must have a contingency plan. So you must say that we're going to do this for the moment, but in the next few years we'll need to look at moving on to something else. And that's another thing. You must always make a firm recommendation. You are not just providing them information, you are advising them. So you must always conclude your answers, your responses in the exam with a recommendation. We can also see that you may be requested to provide advice on special projects as well, and therefore you should be thinking about the stuff that you learnt at E2 about project management, because it could be that you are assisting on a particular project. And it's worth noting that anything from earlier levels, from management level, from operational level, is considered to be fair game by CIMA because it is all considered assumed knowledge. It's knowledge that you should have learnt by now, and therefore it's perfectly acceptable to test it. So that's our role out of the way. Let's take a look at the company itself. Now, the company began life as a dairy farm, as a sole trader dairy farm, established by Jonathan Anderson. And he did this 150 years ago. So this tells you that the company perhaps has a bit of a legacy, it perhaps has a bit of a culture that is built up over these 150 years, and therefore to try and do anything drastic now would be difficult. It also shows that perhaps it is somewhat of an institution in the particular area that it's in, and therefore you have to think about the wider community when considering your options. Perhaps a lot of people in the local area work for the Jonathan Anderson farm or the Anderson Dairy Farming Company. And so when you are building your Mendelow's matrix, going through this pre-seen, listing your stakeholders, we should be thinking about the wider community. And given that this original farm still remains an integral part of the present day larger company, we also have to consider the culture. Is it an Anderson-owned business? Has Jonathan Anderson's way of running a farm been institutionalized throughout the company's history, and therefore does it have a particular culture, a way of doing things? This is the ADF way of doing things, and therefore unlikely to change. This, of course, is an advantage in many ways because they have a way of running the organization that seems to be acceptable to all stakeholders, seems to be successful, etc. But as with all cultural traditions and traditions in general, the problem is people do not assess if they could be improved upon because they simply dismiss it as this is the way that things have always been done, it's always been done well. If it isn't fixed, if it isn't broken, why fix it? And of course, the pre-seen goes on to say that it hasn't remained a sole trader farm, it's incorporated as a business, the Anderson Dairy Farming Company, or ADF as we will call it. Now, the advantage of incorporating it as a company is it is less risky. The company becomes its own legal identity or legal entity, and therefore any issues regarding debt, any issues regarding lawsuits become the company's rather than the owners. So therefore you reduce the risk to the individuals behind the organization. But of course the disadvantage of incorporating company is that you now have to provide accounts, you have to publish your accounts, you have to ensure that auditors come into the company, you now have to make sure you comply with all kinds of new regulations so that you do not break the law or be accused of fraud. Now, despite incorporating as a company, they have never sought a stock market quotation. So they've remained a private limited company this entire time rather than trying to go public. And all of these shares remain with members of the Anderson family. So again, we come back to culture, this family organization. Even though it's now a large organization, a large company, it's still owned and run by the Anderson family, and therefore probably has a very family-centric culture. But whilst that is a good thing, and whilst it's a good thing that perhaps all the shares remain with the Anderson family, meaning that they can make all the decisions, they still have full control of the company, they are key players when it comes to our stakeholder matrix, and also perhaps a strength when it comes to our SWOT analysis, the fact that members of the family who've been brought up in the company are now running the company, so they have all that experience, all that knowledge about the way in which the business works, the way in which the business is run. They are perhaps missing out on all the additional funding that a stock market quotation would bring them. Of course, it would mean handing over some control, but they could raise a substantial amount of finance, which could be a useful way of helping them to expand. And so, therefore, we have a possible exam issue here about funding. How does the company get funding? It will have to take on debt funding, perhaps if it cannot float on the stock market, and of course the risks that come with debt funding, such as having to pay it back, and also the risk that the banks will foreclose on particular assets or whatever you have put up as security. And not only a question on financing, but also perhaps a question directly on the pros and cons and whether they should go forward with a stock market quotation. So obviously you raise more money, but of course you have to give up part of your control of the business. It's also expensive to do so, and you also have to think about all the other things you have to do once you have listed on the stock market. So of course you have to pay dividends, and dividends will be published, and you have the signaling effect of dividends as well. So if you are paying out dividends, are shareholders going to be happy with that? Some shareholders might be, because they view shares and dividends as income. Some may not, because of the high tax rate on them. And also, does paying out dividends indicate to the market that you have no plans for the company? You're not reinvesting the money in the organization because you have no plans for the future. The next section talks about how ADF has expanded in the past. Now, they have expanded through acquisitions. So they've acquired 3 of the neighbouring farms, the most recently being done in 2001. So it's been 15 years since they expanded the business, since they purchased their last farm. So this is quite a slow rate of growth. And of course, you have to consider in the strategic case study exam the various methods of growth. So the main methods obviously being acquiring another company, also being internal growth, internal development, which could be harder here because they're not a manufacturing firm or a tech firm, and also joint ventures. So could they perhaps team up with another company in order to expand? For example, they are a dairy farmer. Could they team up with a company that uses dairy products or milk, etc., to make another product? And they could work with them to expand their revenue stream, because they'll be sharing the profits and the risk with this other company, but they'll also be opening themselves up to a new market perhaps. And where their current strategy also perhaps fails is in its sustainability. Now, currently, purchases of farms that they have acquired have occurred when the owner of those farms has retired. So of course, you may have to wait years for someone to retire, and also there's only a certain number of farms or a certain number of farmers close to retirement age available. And also, if it's all going to be in the area, if they're only acquiring neighbouring farms, then there's only a finite amount that they can buy. There's only a finite extent that they can grow. And so that is something that should be considered if it becomes apparent later on in the pre-scene that the current size of the business, the current operations of the business are becoming less and less profitable, that their current way of expanding and growing the business is very slow and it's very unsustainable. Now, in each farm, they have a shed, the shed of which the cattle are housed, along with the milking equipment. Now, the agricultural industry and the dairy industry in particular is very mechanized. There's a lot of machines involved and a lot of technological development. So when you're thinking about your pestle analysis now, you should be thinking about the development of milking equipment. But also when you're thinking about machines, you need to think about your employees, who are, of course, are stakeholders of your organization. They rely on you for their pay, which of course they in turn need for their mortgages, for food, etc. So you need to be thinking about how the advancements in technology will affect them. Will it mean that their jobs become obsolete and therefore they'll be out of work, which of course could be a problem for them? Or also does it mean that even though they are still required, them being around all this expensive machinery, potentially dangerous machinery, is also an issue. We need to make sure that our employees, our workforce, are well protected, well trained in the art of using these machines so that they can be safe around them. Because of course it could be a nightmare, a PR nightmare, if members of our staff were injured by our machines and it all went out into the papers, and it turns out that ADF had unsafe working conditions. So not only are the cows being mistreated, the staff are mistreated, and it would all just be a snowballing story that could have a real impact on the organization. So the company currently owns 1,600 dairy cattle, approximately 400 in each shed, which of course translates into 4 farms. Now what we should be thinking about here is the fact that we have 4 different farms. Now how are these 4 farms run? How are they managed? Are they all managed by the same person at the top, as it were, in the corporate structure? Or does each farm have autonomy? Are they run independently? Because perhaps what is good for one farm is not good for the other. But of course, as they are all dairy farms with 400 dairy cows, probably they are quite similar in their operations, and then perhaps because of this they can be managed by one central manager or one central board of management. But in addition to these 4 sheds, or these 1 shed on each farm has 250 to 300 acres of farmland. This is used to grow crops for the animal feed and to graze the heifer calves until they are old enough to breed. Now, could be a question here in that amount of land. That's a huge amount of land, and probably a very expensive piece of land to rent or to lease, or if they are owned, then they could probably get a lot of money for selling that land. So it could be that rather than growing all those crops for animal feed, perhaps they could give away some of that land and just buy in the feed. Now, there must be there are other farms that specialize purely in growing crops. Is there an opportunity to perhaps stop doing it ourselves, because that's not our core competence? We are a dairy farm, we are not a crop growing farm, and just buy in the seed, buy in the crops, sorry. Obviously we still need areas to allow the heifer calves to graze, but those calves themselves will not need all of that land. Perhaps there is an opportunity to sell some of that farmland for a high price and then use that money to reinvest inside the business, into our core competence, which is of course dairy farming. Particularly when we go back to the fact that the growing of the farm by acquiring new farms is not that sustainable, or it's quite slow. Perhaps there is an opportunity here to make a lot of additional income that can be invested in new innovations, in new products, etc. Although when we think about buying materials that we used to make ourselves from someone else, we have to think about quality. Are we going to get as good quality as we made ourselves? We have to think about price as well. We make it for a certain amount of, for a certain value, for a certain price. Can we get a price that matches or ideally is lower than that from someone else? If there is a company that sells crops specifically for animal feed, if they are a very big company as well, if they are the big player in the growing crops for selling for animal fields industry, then perhaps they'll have a lot of supplier power as well. So we have to think about that as a potential roadblock or potential downside, something we have to deal with if we were going to move from growing our own crops to buying them. And when you talk about grazing heifer calves, we have to think about ethics as well, because if we do not allow our heifer calves to graze, if we keep them locked in as we do the adult ones, then perhaps that will be considered unethical. And a lot of the times when it comes to animals and animal rights, we have protesters who are willing to go to incredible lengths to expose practices of unethical companies. We also have the modern age of social media, which allows for these kind of images to be shared and for things to become very mainstream very quickly. And I want to just go back to this point about ethics, because I believe this will be a major part of this pre-seen going forward, because as you can imagine, anything that comes to the treatment of animals, using animals, there's always an ethical connotation. We always have to think about how we are treating the animals. Are we treating the animals well? What are the downsides or what are the potential public relation consequences for not treating animals well? And of course, the greater philosophical picture of ethics or argument of ethics that is using animals for profit as a whole, regardless of how you treat them, ethical or not. And for anyone who doubts the power of ethics of social media when it comes to animals, look at the movie Blackfish that came out a few years ago and basically exposed all the ill practices of SeaWorld when it came to the use of orca whales in their acts. Now, they weren't mistreating the orca whales particularly, it was just the fact that keeping them in captivity was in fact mistreatment of them, because they are animals that simply cannot be kept in captivity. They are very social creatures that have huge areas in which they patrol, and thus putting them in tanks was not good for them. Now, there have been protesters for years over the use of orca whales in SeaWorld, and everyone dismissed them. But this film Blackfish, it in a sense brought that attitude from the activists to the mainstream. Now, there is a film recently come out called Cowspiracy, which in a sense attempts to do the same sort of things about the dairy industry, about the meat industry, or the use of cattle in agriculture. And so there is the risk that if this film were to take off like Blackfish did, that the attitude against the use of cattle in the dairy and the meat industry could move from animal rights to the mainstream, and that of course would destroy a lot of the industry. But on the subject of the actual industry itself, we can see that Hilland, which is the place in which ADF is located, is one of the big milk producing countries. Now, this serves as an advantage when it comes to perhaps exporting. We don't know if they export at the moment, but there is a sense of prestige of getting a product from an area, from a country where they are known for that particular product. Now, for example, this could be technology from Japan, cars from Germany, fashion from Italy, etc. If Hilland is one of those places where you get the best dairy products, then that could serve as a selling point if ADF were to trade abroad. But of course, as with everything, it's not that simple. We can't just say, yeah, why not sell our milk abroad? We have to think about transport, the logistics of it. We have to think about potential issues with exchange rates as well. And of course, there may be different laws in certain countries. For example, in Some countries, they have different levels of, or different minimum levels of pasteurization, which is the cleaning of milk once it has been milked from the cows, and therefore what meets the standards in one country may not meet the standards in other countries. And so then you have to balance out whether it's worth going through all the extra regulations required to sell milk in another country. For example, if a country that ADF wanted to sell to had higher standards of pasteurization than Hilland, would ADF then have to spend a lot of money on new machines that they don't need for their own country, for their big market, but just to meet the requirements of a small export opportunity? Will it be financially worth it? These are the other factors that we have to consider, and as a strategic exam you will need to consider when answering your questions. But Hilland itself is a stable and economically developed country. So therefore, when you're looking at your PESA analysis, economically it is a stable country. Economically, perhaps it is quite a wealthy country. But while there is a decent-sized agricultural industry within the country of Hilland, we can see that the country's economy is focused on manufacturing. And so therefore, from a political standpoint, many governments or competing government parties will perhaps prioritize manufacturing over agriculture. And that could be perhaps a bad thing if the country were to go into a recession. The manufacturing industry will be the first one to be saved, so to speak. So that's a potential threat to the organization. And finally, we can see that the Hilland currency is the H dollar. Now, whenever you see something about a currency, you should be thinking about exchange rates. So we spoke earlier about possible exporting opportunities, and so the company will most likely run into economic risk when it comes to exporting abroad because of the strength of the H dollar relative to that other country. If the H dollar is trading with, say, the euro, and the euro is very strong against the H dollar, then it becomes less profitable to sell to the eurozone. However, if the H dollar is very strong, it becomes more profitable to trade with the eurozone. However, the flip side of that is countries in the eurozone will find it less profitable to trade with companies in Hilland. So it's all a balancing act when it comes to exchange rates. And it's something that you must be mindful. There obviously are ways in which you can perhaps use risk management strategies to reduce the risks imposed by exchange rates, such as leading or lagging payments, where you delay or bring forward the payment to take advantage of exchange rates or to mitigate the impact on both parties of exchange rates. You can also have hedges against it, and you can also perhaps just invoice in one particular currency. So you agree with a company in another country to always invoice in their currency or always invoice in your currency. So you're never losing out in a sense. You're never winning necessarily, but you're never losing out. So let's move on to the second page now. And this looks at the organization's structure. So we know it's a family-run entity. We know that it's a private limited company. But now let's look at the specific people behind the organization. So when we think about structures, we should be thinking obviously about the different types of structures that the company could have, the amount of independence particular managers have, the amount of power that they have. We should also be thinking about governance. Now, I'm sure many of you will be thinking, how can we have a question about governance? It's a private organization run by family members. And you'd be right in that sense, in that governance is only mandatory for UK companies, for starters, and also listed companies. But that is not necessarily the case, because with governance is all about the best way to run an organization. Just because there's no legal requirement to abide by governance doesn't mean that a company can't learn something from that. In fact, any organization, no matter how big, no how small, can learn from operating good governance. Because of course, governance is all about mitigating the impact of the agency problem, which of course exists when the owners are separate from the directors, because the owners are the owners of the company and the directors are the people they employ to run the company. The issue is that sometimes directors act for themselves rather than for the business. So they will perhaps leverage short-term performance so they get their performance targets and bonuses all met against long-term performance, which is what the owners of the company want. They want sustainable growth over time. And again, you may think, well, why is that an issue? Because this is a family-run organization. But that's not to say that just because they're family members, that certain people, if they have too much power, won't act without self-interest. Just because they're family doesn't mean that the person in charge won't run it in their own interest. So let's take a look at the organization. Well, first of all, we can see that the organization is headed by Jolene and Archie Anderson, who are joint chief executives. Now, this is an issue as well. Should there really be two chief executives? The point of a chief executive is they are in charge of the company. They're in charge of the running of the organization. By having two people in charge, you perhaps run the risk of groupthink. I know it's only two people, but that doesn't mean that groupthink cannot arise. Now, groupthink is essentially where a group perhaps passes a strategy, they come up with an idea, they put something, they implement something into action that they wouldn't have done on their own. They would not have taken this amount of risk if they were personally responsible. So what you have here is you have two people, neither of whom are directly, individually responsible for the organization because they are both running the organization together. So ironically, given that governance is all about making sure that not one person has too much power, in this instance they've shared the power too much. But despite being in charge of the organization as a whole, they also take direct responsibility for the North Farm. Again, should the people who run the organization as a whole be in charge of one particular farm? Will they perhaps spend too much time working on that one farm, working on the North Farm, rather than running the organization as a whole? Again, perhaps they should delegate this responsibility to someone else. Even if there are no more family members to delegate it to, they may have to bring someone in. But if they're running the organization as a whole, they shouldn't be running a particular department within that organization as well. Because they may end up, again, with this issue in self-interest in doing too much for the North Farm. Perhaps if they've got all the power at the top as well, when it comes to dishing out the funds, dishing out the budgets, will they give themselves on the North Farm a lot more than the others? Will they unfairly prioritise the North Farm ahead of the East, West or South Farm? And between them, they own 22.5 shares. So their joint ownership comes to 45% of the company. So they do not have a controlling stake within the organisation. But for anyone to go against them, basically you'll be looking at everyone else who owns shares being on the opposite side, because if anyone else has agrees with Jolene and Archie, they'll have a majority share. Now, Jolene and Archie are assisted by their 3 children. Now, of course, in a public organisation where you had lots of different shareholders, they would be accused of nepotism in this case because their children are running the organisation with them. But as it's a private family-run business, this in a sense is not direct, it's not immediately wrong. And of course, given that they are a farming family, it's likely that they do actually have a lot of the relevant skills required to run a farm. So Max, Suzanne and Graham have all been brought up in this family. They've probably all worked on the farm since the day they could walk, and therefore they probably are pretty good people to be managers of these particular farms. However, should they also be these dual roles here? Should they also be the director of finance? Should they also be the director of farming operations, the director of human resources? So now we seem to have this cross-functional organizational structure, almost a matrixy type structure. Because Suzanne, for example, is Director of Farming Operations, but she's also Manager of the West Farm. But as Director of Farming Operations, does she have direct input in how the East Farm is managed, in how the South Farm is managed? And do they have the relevant skills required to do their jobs? That, for example, Max Anderson here is the Director of Finance and IT. Well, what IT training has he got? What financial training has he got? Generally, in an organization, you would never have someone who wasn't a qualified accountant, a qualified auditor, etc., being the Director of Finance. Well, what financial training does Max Anderson have? And does he have enough to be considered a suitable person to be the Director of Finance for this organization? And the children, like the mum and dad, own a substantial amount of the shares. They each own 15% of the shares, giving the three children a combined shareholding of 45%, so matching their parents' combined holdings. So again, we have another key shareholder and key stakeholder, and therefore key stakeholder of the organization. But we also start to see an issue here where we do not have perhaps enough dilution of shares. Too many people own too much. So each child owns 15% and the parents own 45%. So what if the parents want to do one thing and one of the children wants to do that as well? Suddenly we have 60% and we have a majority. No matter how strongly the other two children or the remaining 10% think, no matter how much they disagree with what they're proposing, it doesn't matter, because three people have enough shares to become a majority on their own. And so perhaps that's another benefit of perhaps breaking down the shares and selling on the stock market, would be that we would diversify the range of opinion over the company's operations. This is particularly important in this kind of business where we have this family-run culture, where perhaps people who run the organisation, Jolene and Archie, will just do things in the same way that they've always been done. And the remaining 10% of shares are held by several other family members, so probably this 10% will never act as a 10% either. These people will just have no real interest in what's going on in the organisation. They do not have an active role in it. They just own it by virtue of the fact that they are family members, so they're minor shareholders. So on to the actual running of the organisation. And so the farm manager is very much in charge of the day-to-day management. We know that the farm managers are the three children and the parents who each run a farm. And whilst they do this on the day-to-day, the strategic decisions are taken up in family meetings. Now, calling a strategic meeting a family meeting is very indicative of this family culture of the organisation, and thus perhaps the way that it's not as corporate as it perhaps could be. When it comes to family, there will perhaps be levels of compromise that wouldn't be prevalent or present at a private company, at the company where the people were not personally invested. And this, of course, could be a good thing, but at the same time it could be a bad thing, because you do not then argue to the point where you get the best possible outcome. You all compromise because you don't want to risk upsetting each other. Now, on the previous page, we spoke about whether the farms had autonomy or whether they were all controlled as one. Well, at least from a day-to-day perspective, we can see that they are considered to be self-contained. So despite all being next to each other, they do have autonomy in a sense when it comes to the management of its herds, because they're all housed in their particular dairy sheds. So the manager of each shed is responsible for those cows. So they do not necessarily have to act in exactly the same way as the shed manager or the farm manager of the adjacent farms. And these sheds need to be big enough to accommodate the 400 cows and the equipment. So again, this comes back to pestle and technology. Perhaps newer equipment is smaller and thus allows to take up less space and allows the cows to have more room. It also comes back to ethics as well. The cows need to have enough room. We cannot just keep them all pushed in together, because if there were to be some sort of expose from an activist, it could look bad on the company if they're crushed in like sardines, so to speak. And in the next line, or next paragraph, we have some information on recruitment. Now, this is the first time that we've heard about the company employing people rather than simply it just being a family-run, family-owned organization. And when you have recruitment, you have to think about the laws surrounding recruitment. So having to pay a certain amount, having to provide a certain amount of holiday, having to provide an acceptable level of health and safety. We also have to think about the non-legal things, such as the ambitions of employees, the availability of labour. Given that it's a farm, it's most likely in a very rural area, and there is a social stigma perhaps attached to living in rural areas amongst younger generations. A lot of people want to move to the larger cities, and therefore perhaps you do not have the amount of people available, do not have a large pool of employees available in rural locations. Also, it's a very specific type of profession as well, particularly if it requires training. This may make it harder to employ other people, because people will not necessarily view farming as a potential career and will study finance, will study law, medicine, etc. instead, and go off to a more urban location in order to work in those professions. And so when it comes to employment, the company employs shed managers to look after the sheds, and the cow herds to look after the cows. And the farm workers, finally, they're the people who grow the crops. So again, we spoke about earlier about the possibility of stopping growing our own crops and just buying them in. There's some potential employees that we could lose to save costs as well, because of course if we're buying in the crops, we would not need to employ farm workers to grow said crops. But of course we have to consider the negative impact of laying off employees as well, particularly as I've already said, rural recruitment can be difficult. So it could be hard for these other farm workers that we have to lay off to find new jobs, and therefore if they were to go to the press with their stories about how bad their lives have gone since they were laid off from ADF, that could reflect negatively on the company. But regardless of which way we choose, of course, the cattle have to be fed. And this is actually one of the most one of the largest ethical issues when it comes to the meat and the dairy industry. Is actually cows are incredibly inefficient animals in terms of the amount of food they eat compared to the amount of meat or milk they produce. And I mentioned earlier about the film Cowspiracy. This is one of the big things that they mentioned in this film, was the amount of methane created by cows is actually very damaging to the ozone layer, and by increasing the amount of cattle, we're only increasing the damage to the ozone layer, to the environment as a whole. Also, the amount of food they eat, that food could perhaps go to feeding people in some of the poorer parts of the country. The world. For example, the amount of cattle in the United States is over 200 million, and a lot of the reason why that number is so high is purely for dairy and meat purposes. Now, the amount of crops and grains and other things that these cows eat, that 200 million cows eat, could feed nearly 1 billion people in the same period of time. Now, if you think about how many hundreds of millions of people are starving all over the world, and yet that food is being used to feed cattle just to produce milk instead, perhaps it is unethical, perhaps it is not responsible when it comes to the greater global environment. Now finally, we can see that ADF does in fact operate as a single entity. So even though we spoke earlier about the fact that does each farm have its own autonomy, and then it said that actually when it comes to its day-to-day running they do, but the company itself operates as a single entity. So all decisions will ultimately be made by Jolene and Archie at the top, and they're only split out because of convenience, basically to stop the spread of illness, and also perhaps to reduce the size of the herd And of course, a larger herd is far harder to take care of because cows will start running off somewhere when they're trying to be herded into the shed. The sheds themselves will have to be bigger, etc. And it's just easier to perhaps look after a smaller group. And that you could then say that, well, perhaps there's the potential to go further. Perhaps we could split out those 400 into 2 groups of 200. So we'd have 8 groups of 200 rather than 4 groups of 400. But then you perhaps need more cow herds. You need more employees in general, and therefore would be increased costs. What that would do, though, is limit the spread of disease further. Now, this is the biggest risk when it comes to dairy farmers. There is a lot of disease often in cattle. There's a lot of disease on farms, in milk, etc. So it's not inconceivable for disease to arise in a dairy farm. And of course, the more cows you have together, the more packed they are together, particularly if they're packed in these battery sheds, as it were, disease is going to spread quick. One cow could infect the entire herd in that individual shed very, very quickly. And that's a key point here. Just like ethics is a key point, disease is a key point. Because if you think about all the issues that the agricultural industry has had, particularly in, say, the UK, you had the mad cow disease, you also had the foot and mouth issue as well, where a lot of hooved animals had to be slaughtered. Disease can have a huge effect, a very detrimental effect on the agricultural industry. And there's just some pieces here about how the company operates as a single entity. So we can see here that the administrative office deals with all bookkeeping and invoicing across the whole organisation, and the crops grown are used across all 4 farms, not just this is North Farms crops, therefore this feeds North Farms cows. The farm workers and the crops are grown all over and are taken where they are needed. Now, the company also employs a part-time internal auditor. Now, this links back to governance, actually, because internal audits are a key part of the audit committee, which is a key part of governance. So this does actually show good governance here, that they have an internal auditor. The one thing that is perhaps partly questionable is the fact that they're part-time, whereas risks are full-time, and also that it is a very rural area. A lot of people know a lot of people, and that they report directly to Jolene and Archie. So we'd have to perhaps look at the relationship between the part-time auditor and Jolene and Archie. Are they good friends? And if so, is their relationship appropriate? We have to think about independence. We have to think about integrity here, which of course are CIMA principles of ethics. And if we take a look at the 3rd page here, we have the organizational chart, which basically summarizes a lot of what we have been speaking about on the previous page. So again, we can see this joint CEO position, chief executive position. Should there be one person at the top? And also the fact that they run a shed. Now, as they are the CEOs, they should perhaps be managing the organization as a whole and should not be looking at specific parts. We can also see where perhaps the potential problems with these dual roles of the children could come in as well. So we have Max Anderson here, for example, the finance and IT director, Suzanne Anderson, the farming operations. Now, Suzanne Anderson is the director of farming operations, and yet all that sits below her is the shed manager and the West Farm. Now, if she's the director of farming operations, surely what she does will have an impact on the East Farm. Surely it will have an impact on the South Farm, the North Farm as well. And again, with Max Anderson, finance and IT, that too will extend to the entire organization. That will extend back up to the CEOs. It will extend to all the different farms as well. And so therefore, they perhaps actually do have more of a matrix structure, in that the children, they overlook specific farms, but they overlook all farms with their dual role. And again, Graham here is no exception to that as a human resource director. In fact, in good governance, a human resources director would sit alongside the organization as a whole, because of course human resources affects the very top, the middle, and the very bottom. So now that we've looked at the organization and the background of the company, let's solidify and finalize what we've learned so far by taking a look at our SWOT so far. Of course, you know that a SWOT analysis is the strengths, weaknesses, organization and threat to the organization. Strengths and weaknesses generally being internal and in the here and now, and opportunities and threats being external and perhaps more focused on the future. So let's take a look at the strengths of the organization so far. Strengths of the organization that we've come up with so far: we know the hillland location is important because it's one of the big producers of milk in the world. We also have this family culture, which seems to have helped the organization so far. But of course, this could potentially be a negative thing, given that it may lead the company to keeping its traditions rather than looking for ways to improve it. We know that we have knowledge and legacy. The company in all its forms has been around for 150 years and has always been run by an Anderson, as it were. So knowledge has been passed down generation to generation. It's part of the wider community of the area that it's in, and it also has a legacy. It can advertise the fact that it's been around for 150 years. These people know how to run a dairy farm. They've run it for 150 years. They've been producing milk for 150 years. But what about the weaknesses of the organization? Well, for weaknesses, I focused more on the governance and of the running of the organization. Now, we know that they do not have to abide by governance because they are a small privately owned organization, but at the same time, that does not mean they could have benefited from it. And my main focus here is the potential for lack of skills, lack of knowledge, lack of expertise in the non-farming roles. Now, for example, should Max be the Director of Finance and ITT? Should Suzanne be the Director of Farming Operations? Should Graham be the Director of Human Resources and Marketing? We don't have any evidence. Obviously, with Suzanne, perhaps Director of Farming Operations does go along with knowledge of farming. But what about human resources, marketing, finance, IT? We have no evidence to suggest that these people are good at those things or good enough to the extent that they can run a large organization's departments in said fields. And finally, opportunities and threats. Well, I spoke earlier about the potential for exporting overseas as being an opportunity. Obviously, you'd have to factor in exchange rate risks, but we have that background in farming, we have that 150 years, we have that knowledge that Hillland is one of the big milk producing companies. We also have opportunities to diversify. So rather than just say sell our milk for milk, we could sell our milk to go into milk-based products. We could sell our milk for other things. And of course, increased mechanization as well. Agriculture is constantly developing. Could there be ways to cut costs by purchasing more advanced machines that are more efficient? But as with every opportunity, there's also threats as well. Now, some of the threats that I've identified so far in the organization are employment. We do not know how many employees they need at the moment, but there is a chance that employing people may become harder as the agriculture industry declines further and further. More and more people want to move to more urban areas to take more standard office professional jobs, and therefore may make employment harder. Also, the slow growth of the organization. In 150 years, it's gone from 1 farm to 4 farms, and its current way of expanding is to wait for a farmer of an independent farm to retire and then offer to buy it. So what if all the farmers are young? Are we going to wait 50 years? What if they don't want to sell it regardless? What if they just want to pass it on to their own children? And of course, as with any farm, disease is the big threat. Disease could potentially wipe out all your livestock overnight in some instances. But even if it's not as bad as that, it could still have a huge effect, because of course, if you have to put cattle down, then they're not going to produce milk for you. So you've lost your opportunity cost of the milk that they were going to make there. You also cannot sell it for meat because it's diseased meat, and you have to buy another cow to make up for the cow that you've lost, and cows can be very expensive. So I hope you've enjoyed this sample video and more importantly found it useful. Before I go, I'd like to quickly tell you about a few of the products that we do here at Astranti Financial Training, specifically for our case study courses. We have a study text which details all the key theories in which you will be expected to use in your case study exam, as well as details of how to approach the pre-seen and the case study. We also have a series of course videos detailing how to answer case study questions. This is actually an area in which many students struggle. Most of the scripts that I've seen, the failing scripts that I've seen, has actually been due to poor case study technique rather than lack of knowledge. We also have a series of pre-seen analysis videos based on the current up-to-date pre-seen, detailing all the key bits of information and likely issues you may face in the exam. Next up is the industry analysis, a pack detailing information about the industry that the pre-seen company resides in, information about the key players within that industry, and more background information on the industry in general. We also have a range of mock exams created for each level and based on the current pre-seen, which is a great way to get some practice in before you sit the real thing. We also offer marking and feedback on those mock exams so you can see where you are going wrong and where you can improve. Finally, we have the master classes. These are 2 one-day classes taken by our expert tutors to give you all the hints and tips you need to really add to your chances of passing the exam. Also, if you take our full course, we offer a pass guarantee, which, provided you have met all the requirements of the pass guarantee, you will get a free resit on the next exam should you fail to pass. So once again, thank you for your time. If you're interested in any of these products, please visit the website www.astranti.com for more information. Thank you.